Felix here, it's official. We are in a recession. I'm going to walk you through what just happened, what is likely to happen, the trades that Wall Street's putting on, but also the trades that I'm putting on, so you're the best informed investor out there. That's really my plan here, from a random street corner in Seoul, Korea. Now, what triggered the recession thing being official? There's something called the SAM rule. It's sort of a moving average of unemployment. And I'll put the chart on the screen here for you, and you'll see that every time since the 1940s, it's been an incredibly accurate, 100% accurate indicator. So unemployment spikes, we get a recession. Will this time be any different? Well, let's walk through that. But what actually happens next here? Well, Warren Buffett is clearly worried about banks. Why is he worried about banks? Well, he's just sold another stake of his Bank of America shares, second biggest big sell here in a very short period, actually a bunch of sells, but the second time we're reporting on it. And why is that? Because banks have very significant commercial real estate losses, as does Bank of America. Now, is Bank of America going under? No, they're going to get bailed out. But there is one bank that's actually in really, really bad shape, and that's Schwab. So that's one thing to definitely not invest in, I would say. But let's take a step back here. What the heck happened, right? We were happy on Wednesday, weren't we? The Fed was like optimistic. We're going to get rate cuts in September. You know, we're going on holiday. The sun's out and everything was wonderful. And earnings from big tech companies were looking okay. So what the hell happened? Well, the first thing is that, as my mic's camera is slightly swaying in the wind here, Powell basically hinted at a September rate cut, and he kept this optionality open. There could be more rate cuts, and he was also talking about how the labor market is vulnerable, and we've since moved from being exceptionally worried about high inflation to being exceptionally worried about the growth slowdown, the labor market slowdown, the recession coming. And Powell said he was watching very carefully for a sharper labor market downturn, which came only 2 days after he spoke. So this soft landing, this mythical kind of idea that we would just get into this la-la land where nothing bad happens, rates come down, the economy picks up, all of that, is that likely? Well, look back at 2008. What triggered the 2008 recession? Well, we had a huge amount of private and household debt that was built up over this property bubble, and then property market collapsed and it's all over. This time is quite different. Central banks own all the debt. Governments owe all the debt. And government debt can be very easily managed by central banks. They could just buy it, which is money printing, right? Which is what they were doing throughout the whole COVID thing. And corporate balance sheets, so the big companies, they're looking pretty good, actually. There isn't really a huge concern here. And in a sense, that's actually what's allowed the interest rates to stay higher for longer, because the economy didn't break, because the consumer wasn't loaded up with debt up to their eyeballs, plus mortgages in the US generally 20 or 30 years, which is a total scandal in itself, by the way. That's a mindset boggle that banks did to you. It used to be that you got a 5-year mortgage, and then they thought, do you think we can get a stupid customer for 10 years? And the bank said, yeah, let's try it, 10 years. And they did 15, they did 20. And then somebody laughed themselves silly when they realized people were taking out 30-year mortgages. And what does it do? Makes property more expensive, and it makes you a customer for life. Recurring cash flow for banks. They're loving it. But anyway, let's get back to the story here. So growth is now slowing. Inflation seems to be kind of behind us, much like Seoul is here. And the market's now insanely sensitive to worse economic data. And if you realize that interest rates have a lagging effect, as in you raise rates, the impact on the real economy kicks in sort of 18 months later, that's kind of what they taught me in economics, then stuff could get a lot worse. So bad news is officially now bad news. And the turning point last week, and we're going to get to the trades we're about to make and the stuff that Goldman wants us to trade and Wall Street wants us to trade in a second, but the manufacturing data that we got out, which is a pretty important piece of data, and it's been pretty bad for the last 6 months, but the last reading was 46 versus 48 that was expected. And that spooked the market. Why? Because when it's below 50, you're in a recession typically. You're in a manufacturing recession. And we kind of thought we were anyway, a little bit, but it's a much, much worse setup than what we were expecting. And then, as I said, jobless numbers came in on Friday, higher than expected. Unemployment actually ticked up from 4.1 to 4.3%. And if you take that into account, bad manufacturing, more unemployment, a 5.25% interest rate, then this whole like soft landing, Alice in Wonderland, cats coming out of the, thin air kind of thing, turns into, oh my God, the global economy is crashing, it's terrible, panic. And then the Japanese did something really stupid as well, which we don't need to go particularly into, but they raised interest rates when they shouldn't have. And that triggered a whole bunch of trades being unwound, which massively crashed the Japanese economy. So the whole Japanese stocks went down, Asian stocks went down, and then European stocks went down because the Germans have a terrible economy and all that stuff. Now, there is more to this story, and I know it's a little bit of a complex one. It is a weekend. I thought you might be able to absorb it on this weekend. The Trump election odds are decreasing. Maybe you like it, maybe you loathe Trump, whatever, but the market doesn't. The market had a very clear expectation of a Trump victory. The market likes certainty. When somebody's got like 70% approval ratings, that's certainty. We like it. And we expect Trump to cut interest rates. So the plant man is just given away. So we got a bit more of a view here, which is also nice. So we were expecting, but Trump, we kind of know what we're going to get. We're going to get tougher borders. We're going to get more energy, coal, steel production in the US. We're going to get lower taxes. We're going to get all the Wall Street buddies running the country. His vice president is a venture capitalist. The CEO of JP Morgan is rumored to be the next finance secretary and all that stuff. So it's just, Wall Street's wet dream, basically, a Trump presidency. Now, with the odds now moving lower, with Harris entering the race, basically any warm body you can string a half-coherent sentence together does better than Biden because he deserves his rocking chair at this point. The Trump trades get unwound. The markets are now like, which way do we go? Which way do we go? Is it left? Is it right? What do we do? Markets don't like it. And people don't know what to do. What do? They do nothing. What did I do last week? Pretty much nothing, right? So you got that, potentially a tight race. You got the macro risk around the world. So what's the solution? Well, Wall Street proposed a very simple solution. They asked the Federal Reserve to panic. Goldman Sachs begins their commentary by saying today, the softening in labor market conditions has now gone beyond the amount that was welcome. As a result, Goldman now expects an initial string of consecutive rate cuts in September, November, and December, whereas before they were just expecting a rate cut every other Fed meeting. So that's basically, okay, Fed's going to bail us out. They always have. They'll do it again. Brilliant. So we're going to get 3 rate cuts. Okay. But the Goldman's chief economist, who was one of the biggest bulls out there for years. He was a bull Friday morning up till 8:29. At 8:30, when the jobs data came out, he was like, oh, I better flip on this. And he writes, the slowdown in job growth in July report likely overstates the decline in the underlying trend if the August employment report is also weak and confirms the slowdown in job growth. Then, wait for it, a 50 basis points, so a half a percentage point cut would become likely at the September meeting. So Goldman's now saying we're going to get a 0.5% cut, right? Which would be nice, bail us out. So do you think that they're a bit desperate over there, a bit freaking out? Well, listen to JP Morgan. They're now saying or asking for consecutive 0.5 percentage point cuts, which is rather remarkable. Again, huge bull at JP Morgan. Their chief economist is a chap called Ferroli. You can troll him on Twitter if you like. And he woke up this morning and said, we're going to get September and November cuts. So basically 1% cut by November. Panic, freak out, everybody at the Fed. And that way our trades will do just fine. Is that likely? You'd have to get a lot worse economic data in, I think, for the Fed to do that, because this Fed president is a little bit slow to the party, and then when he gets going, he really gets going, right? But you got to ask yourself, do these economists matter at JP Morgan, Bank of America, Goldman Sachs, these Wall Street guys? No, they don't. There is a smarter thing. There's something called interest rate swaps, which show you what the traders are putting their money on, and they're saying there is now a 70% likelihood of a 0.5 percentage cut in interest rates in September and over 1% by the end of the year. So that's pretty good if we get it, right? If we don't, it's like, so is that the solution? Well, no, I think, let me walk you through what Wall Street's proposing as trades. And these are trades they don't send out to you and me, they send them out to institutional traders. They're saying be long VIX or in the VIX. Now, be a little careful with that, because I said that about a month ago, and we made money on that trade, and we closed it, maybe a little prematurely, okay, but we made money, and that's the main thing. The VIX is at 21. If the VIX goes to 30, it's like, oh my God, freak out. Possible, but it could also come back down to like 15 or 16, in which case you lose your shirt. So be a little bit careful with that. The second thing they're saying is short the DAX. Now, what the hell is the DAX? It's not a DAX hound or some sort of forest creature. No, it is the German stock exchange index. And it's not something I would generally invest in, because it's massively underperformed the US markets. The Germans listening will be going, really? What? Oh my God, I thought I was investing in the best market in the world. It's a bit like the Brits. The FTSE is even worse. If Trump wins, German companies, who are all massive exporters to the US, will face 10% tariffs, according to the Orange Donald. And that will significantly tank the German DAX. At the same time, the Chinese economy slowing down will also continue to tank German industrial companies who export a lot, because again, Germany is the only country in the world that exports more to China than it imports. And therefore, could be a reasonable thing to do. Actually, not that easy to short the DAX. I mean, you could short sell it. I don't generally recommend it. There's no options activity on that I could find, but there's probably a way to do it. Anyway, that's what Wall Street's doing. They're also buying gold hand over fist, and they're shorting oil. Why? Gold generally, when the world goes up and, poof, then like that. What's that cat called in Alice in Wonderland? The little one? I like that one. People buy gold. Our internal gold trader, our former market maker, Elliot, he's a former London Metal Exchange trader. He likes the gold trade, if you watch our newsletter. And then short oil. Now, why the heck would you short oil when the Middle East is about to go in on flames? Because economy slows, we need less oil. Trump gets in, guess what? You're going to get tariffs on imported oil, which means international oil prices will fall because the US it's more than self-sufficient, right? Now, that's Wall Street. So what am I doing? I'm not actually doing that. I'm not actually doing any of that, because I'm not hugely comfortable in gold or in oil or shorting things. So I already closed my IWM trade off last week. Lost about $400 on that. We can live with that. That's okay. And why did I lose money on that? Execution mistake. I set it up before the Fed meeting. I should have closed it straight after. And I thought I'd set up a trading stop loss. I hadn't. I'd only set up profit taking. I hadn't set up my stop loss, which was an error. But it's okay. $400 down. We learn and we live. And you continue to learn even if you trade for 10 years, and you'll continue to make mistakes, and that's okay. That's why we do consistent small trade sizing. And if you want to learn that, by the way, if you're still here listening to me rant on, join me on Tuesday, felixprehn.org/webinar, and I'll show you how we can automate those rules. And I should have done that. I would have been up a couple of $100 rather than down 400. I'm also going to buy call options again, more call options on Tesla. Why? I think the stock's undervalued. It hasn't done a thing. It hasn't done a thing this year. It hasn't done a thing over the last year. And I think the future of that business is going to become more clear, and that it isn't just selling cars. So I like it. And how do I do that? I'd probably just buy a 2026 leap call option or something like that. Now, not a recommendation. If you don't know what that is, if you don't know what that means, again, join me on Tuesday. I'll walk you through some of that. But don't ever jump in on something because some chap on YouTube who's a bit stark raving mad and is standing in the middle of Korea is telling you to do it. I'm not telling you to do it. I'm just being transparent here. I will also do the same for PayPal. Why? Because earnings were good. Management's doing the right things. They're moving in the right direction. Margins are improving. So a few more quarters, I think, of Alex, and I think this company will look a heck of a lot better. And why did it get pummeled on Friday? Just general macro. Japan's got nothing to do with PayPal, nor does any of the other nonsense out there. Falling interest rates will be good for PayPal, so I like it. And last but not least, SoFi. Why? Again, earnings were very, very good. The market doesn't really understand it. Management is building a new business inside of SoFi. They call it the AWS of fintech. The market doesn't get it. The market doesn't understand it. The market's going, complicated. Let's have another line of something and do the usual. And SoFi will massively benefit from falling interest rates. So in a sense, the worse the shit show out there gets, the better for SoFi, because their existing borrowers have super high FICO scores and lots of income, and they're going to repay anyway. And everybody else out there who wants to refinance when interest rates come down a percentage point will, and they'll give SoFi a call. And at the same time, they're building out the new business. So I like all of these three. Medium-term horizon, sort of like 1 to 2 years is kind of my view on those. So it's not like a get-rich-quick scheme. And of course, don't go out and buy them just because I mentioned it. Do your own bloody research. And that's about it, really. We're enjoying our trip here in Korea tremendously. It's lovely. It's blue sky. Can you see that? Very, very nice blue sky. And we've had some tremendous food. Lovely people. Done a bit of shopping. And are going to go and get a nice airport car back from the hotel in about 2 hours after lunch, sit in a beautiful, very comfortable seat, lay back, relax, maybe have a nap, get picked up on the other end, and just enjoy life. And if there's only one thing I can say to you is, I used to come here for business, and it was stressful. I had all these 10 meetings a day and 8 meetings a day and all that kind of thing. And I didn't enjoy it. It was stressful. It was horrible. It was, I mean, just horrible is perhaps an exaggeration, but it was not what I wanted to do with my life. And now I come here, why? Just because I feel like it. and that's lovely. And that's free freedom. And that means just you decide on a Tuesday, let's go to Korea on Thursday, and book a flight, book a hotel via WhatsApp, and get here and just enjoy it and see some different people, see some different ideas, sit in a different environment, and it just opens your mind. So travel for me is one of those things that I think it's not a luxury. I think it's just something that gives you interaction with the world and gives you different perspectives. I think it makes you smarter, and I absolutely love it. And I'd encourage you to build more income streams that take you less time, because that's the only thing that gives you freedom. And I've tried lots of things, bunch of different businesses, from wine to chemicals to fashion to publishing to loads of stuff. Some has worked very nicely, some hasn't. And try it all. But the thing that I find the easiest, least time intensive, and rather profitable is trading. And I do it a couple of hours a week. Sometimes I don't do anything for weeks on end, and we still make money. So if you want to learn what we do, learn our rules and strategies, then I'll do that for you for free, because you deserve it. felixprehn.org/webinar. I thank you for tuning in. Smash the you-know-what, and see you on the next one. Felix here, and with Palantir earnings in just under a week as I'm recording this, I want you to be the best prepared investor out there. And so many retail investors make these big whopping mistakes before earnings. And by the end of this video, you will not be one of those. So let's profit and maximize from that.